Okay, welcome back. So, let us continue our discussion, our session about credit models. So, why credit models? So, the fourth point is an increase in the off balance sheet risk. So, you have different type of risk corresponding to whether loan has been taken on a higher interest rate, lower interest rate, whether you are trying to run a business for a sector which is under in the zone where there is huge amount of competition, or whether there is less competition, whether the number of players has increased or whether the number of players have decreased, whether the market share has increased, decreased. So, all these things would basically be given in some way in the profit and loss and definitely in the balance sheet account. Shrinking margins in loan which have forced banks to explore less costly ways of trying to give the loan. So, obviously, as there are different type of banks, different type of financial institutions, different type of lending agencies who are willing to lend, and they are willing to lend for different type of sectors also. So, the companies are trying to bargain where they are able to get a loan at a much more competitive rates. Development of more efficient credit risk models has come into the market, where the financial fundamentals, the mathematical models are able to take care in a much better fashion, such that they are able to give a much more clearer picture about how the company is doing. Advances in general financial theories which provide in general a good overview, a good understanding of Kaplan model, APT model, Black-Scholes models, and so on and so forth are now being considered in order to analyze the credit models in a much better way. Domain of applications of credit risk models are generally in the credit approval, that is used in conjunction with the judgment of to override systems for approving credit to customers, or whether credit is actually applicable to be given, whether credit should be enhanced, credit should be reduced, what is the overall risk of the credit, whether the company is now facing a huge amount of risk and subsequently the credit rating should be decreased or vice versa. So, those are the actual domain of application. Credit rating determination is used to basically rate unrated securities or unrated different type of financial ventures. So, if you want to go into a business which has not been yet been analyzed by any different type of financial institution, or if you whether you as a company are going into this sector for the first time, then obviously your forte is there, say for example, in manufacturing sector, or is there in service sector, or is there in steel sector, or is there in automobile sector, but you want to venture in some different areas. So, obviously, that is a new venture, and the overall risk perception which the bank thinks with respect of you means an organization who is trying to go into the business, is totally different in this new sector than with respect in the old sector where you were operating. So, those have to be analyzed, and those unrated securities which we are trying to float, they would be analyzed. So, this is also a domain of application for the credit models. Credit pricing is important, and that is one of the another domain applications used to suggest the risk premium that should be charged in view of the loss and default. So, if you have been defaulting, if the overall risk is high, or whether the overall risk is low, or whether the competition is high and low, then obviously the credit rating agency, the banks, the people who are willing to give the loan would try to analyze the problem in a new perspective and see what is the overall risk, enhanced risk, lower risk, which they would be facing, with the lenders would be facing, with the banks would be facing, with the investors would be facing, considering the company is willing to venture into that area. Financial early warning. So, obviously, if you do a good use good models and you try to basically evaluate the performance on the company on a regular basis, then if there is a default of risk, or if the overall risk perception is increasing in the market, or whether the company is doing bad, or whether the market share is shrinking, or whether the number of players is increasing, obviously, all these informations are in a way given in the credit model, such that some early warning systems can be made into place, such that people can take care of that in a rational manner. So, for an application of credit models, the common credit language would be same. So, what Standard and Poor's would do, and based on which it will give the rating of a company as AA or BB plus, should be the same way in which Moody's would do and give the same type of rating. So, if the set of informations or set of variables or set of parameters based on which you as a company are trying to analyze a person or an organization which has asked for a loan, should not differ, the analysis, the output result should not differ from the one which some other person who has the same set of knowledge is trying to analyze. That means, there should be some parity in the way the things are analyzed. Collection strategies. So, this if your default risk is increasing or your default risk is decreasing. So, obviously, that should give you some warning signals that whether the collaterals should be increased, should be decreased, or whether the overall quality of the collateral should be changed, point number 1. Point number 2, if your level of default is increasing, obviously, it sends a warning signal to the people who have lent the money that their money should be collected much more before than actually its period of collection is. Or say for example, there should be a third party which is willing to take the risk. So, if you initially trying to utilize the credit model in order to understand the credit rating concept of a particular company, and if say for example, the company has taken a loan and if the credit rating is very high or very low, then obviously, the concept of having a third party in order to basically buttress the overall risk perception which the company who is lending the money should be taken into account in such a way that the credit rating models gives that picture or gives that early warning signal much beforehand. So, accounting based principle based or accounting concept based credit rating scores, each industry has some norms for each and every ratios, all the financial ratios which you have considered. So, a company is analyzed against the standard industry perception. These univariate models, why univariate? Because you consider only one variable or one parameter for study. These univariate models are inadequate in predicting the sickness of the company. Hence, multivariate models are generally used, where you try to combine the interrelationship effect which is happening between these different ratios. What ratio, what effect does the financial issues have on the different type of market share? What is the leverage ratio, what does the collection period, whether they have effect on the overall credit rating concept, what is the correlation coefficient existing between these variables, that should also be taken into account in a very rational manner, such that the overall picture which you are getting is much better than considering them on a standalone basis. So, we will consider 5 or 6 different ratios. So, the first person who had considered this was Altman. So, that is known as the Altman Z-Score. So, Altman basically came out with this study in the Journal of Finance in the 1968. So, he used multivariate discriminant analysis for finding this score. So, the score is depending on what type of sector which you have studied is given by this simple equation, is this one. So, x1 is basically the working capital to total assets, which will be considered from the balance sheet, profit and loss account and the trial balance. X2 is the retained earning by total assets, earning before interest rate and income tax, EBIT. This is the EBIT, earning before interest and income tax. By total assets, market value of equity by book value of total liabilities, and sales by total assets are respectively x3, x4 and x5. So, once you plug in all these values with these ratios with and taking this constants as given 0.012, 0.014, 0.033, 0.006, 0.999. So, what are these values? In a very simple manner, consider that if x2, x3, x4, x5 are all constant, not changing with respect to time, then and if x1 is changing, then the rate of change of x1, its effect on z, which is basically the overall index or the Altman Z-Score, has an effect of 0.012 unit. Similarly, if x1, x3, x4, x5 are constant, then the effect of x2 would be at a rate of 0.014 and so on and so forth for x3, which is 0.033, for x4 it is 0.006 and for x5 it is 0.999. So, this is the Altman score. So, if you go into the details of the Altman score and study the overall analysis, it gives you for the first one the working capital to the total assets. If firms are doing poorly, firms doing poorly would have a shrinking value of current asset in relation to the total assets, hence it would have a effect on the overall Z-score. See for example, for the second one, retained earning to total assets, if the total retained or earning earned surplus is the total amount of reinvestment earning or losses of a firm over an entire time. Young firms have a lower value of retained earning to total assets. Returning the amount of money which is being retained in the firm. Earning before interest income tax by total assets, which is EBIT. It is a measure of the productivity of the firm's asset independence of tax. So, higher the value of after income tax, after interest rate which has been paid, if the value is very high, obviously it means the company has been able to retain a whole amount of money in its coffers to run its business or convert that into, say for example, for investment in R&D account as and when necessary. Market value of equity to book value of total assets is equity is measured by the combined value of all assets of stocks, preferred and common, whereas liabilities include both current accounts and long term liabilities. And finally, sales to as total assets, this capital turnover ratio, which is known as the capital turnover ratio, illustrates the sale generating ability of the firm's asset. Now, if you do go into the details, what does the Z-score imply? These are like this. If it is a public industrial company in US in the 1960s, as the study has been done, or early or 1950s, and if you have a set of company which is the private industrial companies, then score of the first case, if Z is greater than 2.9, Z is between 1.81 to 2.9 and less than 1.81, then the company respectively can be categorized as healthy, as in the gray region, which is not healthy, not poor, and in the unhealthy region. So, depending on the Z-score, you can definitely quantify that. If it is a private industrial company, the corresponding values for a healthy company, gray company and unhealthy company are respectively, if Z is greater than 2.60, if Z is between 1.1 to 2.59, which is or 2.60, and company is unhealthy if it is less than 1.1. So, later on Altman also worked on different models. Other Altman models are emerging market score models. It came out in the 1997, and the different ratios which was much more than Altman first Z-scores are different currencies. So, if you are trying to analyze a company which is a transnational company, multinational company, then obviously operation, how the company is doing in different countries, what is the currency risk, and all these things should be taken into account. So, different currencies, industry risk different, being in different countries, industry characteristics being different, economy being different, political environment, lack of credit experience, all these things in a qualitative and quantitative features were considered by emerging market score, which was proposed by Altman and his two authors. And this is also a much more better model than Altman Z-score. Then you had the ZETA Score model, again proposed by Altman. So, that also came out in 1977. The main difference of this ZETA model with respect to Z-score are changing trend in government rules and regarding bankruptcy rules was considered in the ZETA score, not in the Z-score. It focused on much larger in terms of size of company. So, size of the company or the size of the firm was also considered in a very nice way in this ZETA score model. Changing trends in standards and accepted accounting principles were also considered in the ZETA score, and refinement in the discriminant analysis techniques, statistical techniques were utilized in the ZETA score rather than in the Z-score model of Altman. Now, in the ZETA score, the variables used are X1, which is the return to asset, which is EBIT total sales, S2 is stability of earnings, X3 is debt interest, X4 is cumulative profitability, X5 is liquidity, X6 is capitalization, X7 is the size. So, this is a size concept which is being brought into the ZETA score, which was not there in the Altman Z-score model. So, these in details what is the effect of X2, what is the effect of X4. So, all these things are mentioned. I am not going to go into details, you can check the slides, but let me continue in trying to analyze other models which are also there in the industry. You have the Olson's O-score, it came out in 1990, this is the financial ratios and probabilistic prediction of bankruptcy, where they use for the first time the concept of probability to find out what is the range of scores between which a company can be mentioned as bankrupt and non-bankrupt. So, this probability of failure of which according to Altman score is given by 1 by 1 plus exponential minus NV. NP is basically the net value of the company. So, where the different ratios which you see y1, y2, y3, y4, y5, y6, y7, y8 and depending on all the variables or fixed values which are the y1 to y8 are as given log of total assets to GDP value, total liabilities to total asset, working capital by total assets and so on and so forth till now. Now, according to Altman score, if probability is less than 0.03, then the company is not bankrupt, else we say the company is bankrupt. Obviously, more refinement can be done in the Altman score to find out different regions where you can definitely term with some certain probability depending on the value as a company is definitely doing well, whether the company is in the gray area or whether the company is in the bankrupt stage. The Altman score also is in another format is given by Griffin and Lemon. Again the same type of Altman scores where the value O is the Altman score and all the variables y1, y8, it is here y9 here, it was y8 there. They have the same implications and you can find it out reading this slides or reading the journal paper which is given here. So, Altman score with updated coefficient is given by this. This was found in one paper later of working of Altman after it was given for the first time. So, these again y1 to y8 are the variables as discussed and the constants are given as minus 5.91, 0.04, 0.08 are the corresponding rate of change of this y1 to y9 depending other values are constant. This is a very simple definition which I am trying to give you. Now, we have used very simply, even though the data may be a little bit old, we have used the values of the Z-score and the Altman score for Philips India depending on all the ratios which are there starting from 1990 to 2002. Obviously, it would have been better if we have got quarterly results for each year or if we had the results for the till 2015, then answer the overall scenario which we could have given would have been much better, but the analysis which you have done also gives you a good decent overview how the company is doing and whether steps should be taken by the creditors or steps should be taken by the company in order to basically tighten its belts or basically make a overall view where it is going wrong. So, if I consider the scores, this one, the pink, the blue one and the yellow one are basically let me see. So, this Z score is basically all the ZETA score, the Z score and the emerging Martin score values which are given for Philips from the 1990s to the 2002. If you see the values, so if I think value, this is basically the trend of the Z score. This is nothing to do with ZETA score or emerging Martin score. These are the threshold values which I have taken depending on whether it is a bankrupt or a non-bankrupt one. So, you see in this trend in 1990s to 91 it was not doing well, then it started increasing and if you see the trend there is a sharp fall. So, if you continue and doing a good analysis of 2003, 4, 5, 6 obviously that will give us a better answer. Now, only thing is note this trend, this is by the Z score model for Philips. So, let us now switch to the Altman score. Again if you see the trend, pay more attention to the trend. This trend and the last one which you have got using the Z score are almost the same. So, which means that the models are specific to the internal set of information, nothing to do with the model as such. So, if you have built up a model which takes care of all these variables in a very scientific manner, in a rational manner, then the results of two different models would also give you the same type of analysis. So, the type of analysis which may infer from using the Z score for Philips from 1990 to 2002 and then using the Altman score again from 1990 to 2002 are almost the same. It means in the initial 2 years it was definitely not good, then it started increasing and in the last year again there was a dip in the trend, which is exactly what you are getting in both the graphs when you are trying to analyze the Z score and the Altman score. When I combine them, so depending on the levels, you have basically the pink one is the Z score and the this light violet one is basically for the old score or the Altman score. So, these are the trends which you see. This is the one for Z1 and this is the one for the Altman score. So, you see this almost they are basically following parallel to each other. So, obviously, the overall analysis which you can derive from both of them are internally exactly the same. So, the fundamental concept which you will be getting from both the models will be exactly the same. Then you have the Zmijewski score. It was given in 1984 and came out in Journal of Accounting. Again, you have to basically have the concept of probability. The probability of the failure of the Zmijewski score is given where the variables under study are x1, x2, x3, which is given by net income by total assets, total debts by total assets, and x3 is basically the current assets by total liabilities. So, remember, if the probability of failure is greater than 0.5, then it implies bankruptcy, else the company is not failing. So, obviously, analysis can be done for all these models taken separately. To wrap it up, we will just consider the last one, which is the Zavgren score, which came out again in 1983. There are other models also, but I am only discussing the important one. Again, it gives you on a probability aspect what is the ratio, or based on the ratios what is the probability of failure. So, again if you see it is basically exponential type 1 plus 1 by exponential to the power minus AS2, which is the Zavgren model, and this basically models consider the variables which is from x1 to x8, which are net income to total sales, and the last one means net sales, which is my fixed asset but working capital, net working capital. So, again you have, if the probability is greater than 0.5, it is basically a bankruptcy, unless it is not. So, with this I'll end the discussion for the different type of credit models in a very simple manner, and then continue with other discussions of credit models and how they can be analyzed in a much better way. But these models are not that I am trying to give you end analysis of all these things, just to give you the interest that these models are existing in the market, and you definitely, if you do a thorough analysis using the different fundamental principles of the company, using the balance sheet, profit and loss account, and some good mathematical techniques, statistical techniques, you can find a lot of information and try to analyze a company in a very rational manner. With this, I will end the class, and thank you very much.